Welcome to the deep dive. Today we're pulling back the curtain on a company you might not know by name, ASML, but their technology, it's absolutely foundational. Think smartphones, AI servers, all that advanced tech.
That's right. It's kind of invisible but essential.
Exactly. So we're going to unpack what they do, why they're so, well, dominant. We'll look at their strategy, the risks, and yeah, what's been going on with their stock lately, and what you, our listener, should maybe keep an eye on.
And we're drawing on some solid sources here. A recent Copascope research report, ASML's own Q2 2025 earnings call, and some recent stock updates. The mission is really to distill it all down for you.
Give you the essential picture.
Precisely. A clear view of this pretty new semiconductor giant.
Okay, so let's start right at the beginning. What does ASML actually do? People throw around semiconductor equipment, but what does that mean in their case?
Right. So at its core, ASML builds these incredibly specialized machines. They're called photolithography systems.
Photolithography? Okay.
Yeah, think of them as ultra precise printers. But instead of ink on paper, they're creating these minuscule, intricate circuit patterns on silicon wafers, the semiconductor chips.
Ah, so they're literally drawing the blueprints onto the chip itself.
Exactly. Every single chip, from the simplest to the most complex AI processor, needs this lithography step. ASML designs them, builds them, and importantly, services these machines for chip makers worldwide.
Wow, that sounds incredibly complex. So, okay, they build these giant printers, but what are their main lines of business? Is it just selling the machines?
Well, selling the machines is definitely the core. That's their lithography systems business. And it's kind of split into two main types.
Okay.
First, you've got extreme ultraviolet lithography, or EUV. These are the absolute cutting edge, the crown jewels, really.
EUV, that's the one you always hear about for the advanced stuff.
That's the one. It's essential for making those leading edge chips, think 5 nanometers, 3 nanometers, even smaller. The kind you need for high performance computing, big AI models, the latest smartphones.
Nanometers. We're talking unbelievably tiny scales here.
Oh, absolutely. And the key thing, ASML is the only company in the world that makes EUV machines, a complete monopoly.
Really? The only one?
The only one. Then, the second type is deep ultraviolet lithography, or DUV. These are the workhorses for more mainstream chips, 28 nanometers and above. Still critical for tons of stuff, cars, industrial tech, consumer electronics, but not quite that bleeding edge.
Got it. EUV for the absolute cutting edge, DUV for everything else. So they build these massive complex machines. What happens after the sale? I mean, these things must cost a fortune.
They do. And that leads straight into their second major business line, installed base management.
Service and support, basically.
Exactly, but it's more than just fixing things. Because these machines are so complex and vital for chip production, chip makers rely heavily on ASML for long-term maintenance, yes, but also hardware and software support, keeping them running perfectly 24/7.
Makes sense. Downtime must be incredibly expensive for a chip fab.
Hugely. And this segment also includes crucial upgrades, maybe boosting the machine's speed, its wafers per hour rate, or enabling it to handle slightly more advanced chip designs. It's a really significant, stable, recurring revenue stream for them.
Okay, so machines and service. I think I saw something about other specialized offerings too, like diagnostics.
You did. Yeah, through an acquisition, they made a company called HMI, Hermes Microvision. They offer metrology and inspection systems. Think of these as super advanced quality control.
Finding the tiny flaws.
Exactly. Detecting minuscule defects during manufacturing. This is critical for maximizing yield. Getting as many good chips as possible off each wafer saves chip makers a ton of money. And they also provide sophisticated software solutions that tie into their machines, optimize the whole patterning process.
Computational lithography, things like that.
Right, making the whole process smarter and more efficient. And underpinning absolutely everything is just massive research and development, R&D. Especially for the next generation, high-NA EUV. That's a huge part of their business model, constantly pushing the boundary.
So if we had to bundle it up for someone listening, what are the main buckets?
I'd say 3 main pillars, really. You've got the core lithography systems selling the EUV and DUV machines, then the aftermarket and services that install base management, and finally innovation and adjunct tech. The metrology, the software, all driven by that huge R&D spend.
Okay, that clarifies things. Given how critical this tech is, especially EUV, where they're the only player, I mean, how did they get here? How did they build this, well, near monopoly? What's their competitive advantage?
It's a fascinating story, and they've built this incredibly strong moat. The absolute number one advantage is that EUV leadership.
Hmm.
Like we said, they're literally the only company making these tools. If you're TSMC, Intel, Samsung, and you want to make chips at 5 nanometers or below,
You have to buy from ASML. No other option.
no other option. And they're not standing still. Their next big thing is high NA EUV technology. NA stands for numerical aperture. Basically, it means the optics can resolve even finer details.
So even more precise printing.
Exactly. Pushing towards sub-2 nanometer nodes, it's not just an incremental improvement, it's potentially a big leap in efficiency for the chip makers too. Expected to launch commercially around 2025.
Wow, so they're extending their lead even further.
Absolutely. Then there's the sheer scale of their R&D investment. Over 4 billion euros a year just on lithography R&D. Their competitors, not even close. It creates this massive technological barrier.
4 billion euros a year.
Yeah. Plus, they have these incredibly deep, long-term customer relationships. We're talking about the giants TSMC, Intel, Samsung. These aren't just buyer-seller deals, they're deep partnerships. Some customers, like TSMC, actually help fund EUV development in the early days.
So they're deeply embedded.
Very. And finally, don't forget those recurring revenue streams from the installed base management. It's stable, high margin, and growing. And get this, the new high-NA EUV machines, they're expected to generate over 150% of their initial purchase price in service revenue over their lifetime because they're even more complex.
Well, 150% just in service.
Over the lifetime, yeah.
There.
It's huge.
Okay, that paints a picture of, frankly, near invincible dominance. But every company has vulnerabilities, right? What keeps ASML awake at night? Where are the potential cracks?
Right, no companies without risks. And ASML has some significant ones. A big one is dependence on single-source suppliers, particularly Carl Zeiss, the German company that makes the incredibly complex optics for their machines.
The lenses and mirrors.
Exactly. Ultra precise, incredibly hard to make. If Zeiss has a fire, a production issue, it could directly impact ASML's output. That's a major bottleneck.
That's a big dependency.
It is. Then there are geopolitical risks. This is a huge one right now. U.S.-China trade tensions, export controls. These have already restricted ASML from selling its most advanced EUV systems to China and even some of the higher-end DUV systems.
So that directly limits their market.
It does. It impacts their total addressable market and creates uncertainty. Then there's customer concentration. Like we said, TSMC, Samsung, Intel are their biggest customers. If any one of them decides to cut back significantly on capital spending,
ASML feels it immediately.
big time. And the whole semiconductor industry is notoriously cyclical, booms and busts. An economic downturn can quickly lead to lower chip demand, which means fewer orders for new equipment. And while it seems distant now, there's always a theoretical technology convergence risk. Could Nikon, Canon, or maybe a heavily state-backed Chinese player like SME eventually catch up? Unlikely soon, but it's a long-term possibility.
You mentioned Nikon, Canon, and SME. Let's talk about them. How do they actually stack up against ASML today?
Well, Nikon is still a player in the DUV market, especially for older chip nodes. They make good machines,
Yeah.
but critically, they have zero EUV capability. Their R&D spend is like a tenth of ASML's. Market share is small, maybe 5–10%.
Okay, so DUV only, much smaller scale. What about Canon?
Canon is even further down the ladder. They focus mostly on entry-level DUV, the really cost-sensitive end of the market. They have almost no presence in advanced lithography.
So not really a direct competitor at the high end. And SME, Shanghai Microelectronics.
SME is interesting. They primarily serve the domestic Chinese market, partly because of the export restrictions on ASML. But technologically, they're way behind. Maybe capable of 28 nanometer nodes, possibly a bit better now, but nowhere near the cutting edge. They lack the whole ecosystem, the optics, the light sources, the software needed for advanced stuff like EUV.
So the takeaway seems pretty clear.
Yeah, it really is. ASML's monopoly in EUV is completely unchallenged right now. Their R&D muscle, those deep customer ties,
Yeah.
it gives them this structural advantage that competitors are, frankly, decades away from overcoming.
Okay, so ASML sits on this incredible competitive high ground. Looking forward, what's their plan? How do they intend to grow from here? What's the strategy?
The main growth driver is pretty straightforward. Push the adoption of EUV and the upcoming high-NA EUV. These technologies are absolutely essential for the chips powering the biggest growth trends: AI, high-performance computing, advanced 5G, eventually 6G.
So ride the wave of demand for more powerful chips.
Yes, exactly. High-NA EUV is key. to enabling those sub-2 nanometer nodes, making chips even denser and more powerful, and potentially lowering manufacturing costs for their customers compared to using current EUV for multiple patterning steps. And they back this up with that massive R&D investment to stay ahead.
Always innovating.
Constantly. And that installed base management we talked about, that's not just stability, it's a growth engine too. It's about 30% of revenue now, high margin, and it grows as the number of ASML machines in the field increases. And as we said, the high-NA machines are expected to be even more service intensive.
So more recurring revenue down the line.
Right. They're also looking to diversify revenue a bit more through those integrated metrology solutions and other software and services that help customers run their factories more efficiently. It all ties together. Their long-term guidance reflects this. They're talking about potentially doubling revenue between 2025 and 2030, aiming for EUR 44 to 60 billion, with gross margins expanding into the high 50s, maybe even 60%.
That's incredibly ambitious growth. How does that compare to what, say, Nikon or Canon are aiming for?
Oh, it's night and day. Nikon and Canon are focused on that legacy DUV market. It's stable, maybe, but it's not a high-growth area. It might even decline slowly. SME's growth is tied entirely to Chinese domestic policy and catching up technologically, but they're locked out of the most advanced nodes.
So ASML is playing a totally different game.
Completely. Their growth is tied to the fundamental progression of Moore's Law, or whatever you want to call it now. The need for more advanced chips is structural. Their strategy feels much more achievable and sustainable because of their unique position and that recurring revenue base.
Okay, the strategy makes sense, the position is dominant, but executing on this, what are the biggest risks in practice? What could trip them up as they try to deliver on this plan?
Yeah, execution's where the rubber meets the road, especially with tech this complex. That supply chain dependence on Zeiss is a major one. Any hiccup there directly impacts their ability to build machines.
The Zeiss bottleneck.
Exactly. And just the sheer product delivery complexity. These EUV machines, especially high-NA, are monstrously complex. They take 12, maybe 18 months to build, install, and calibrate. Getting those first high-NA systems delivered on time in 2025 and ramped up smoothly by customers is absolutely critical. Any delays ripple through the whole industry.
High stakes for those initial deliveries.
Very high stakes. Then there's the customer concentration risk again. If TSMC, Samsung, or Intel hit a snag, maybe delay building a new factory, that directly impacts ASML's order book and revenue timing.
Those big three hold a lot of sway.
They do. Geopolitical risks remain a constant execution challenge. Navigating export controls, potential tariffs, supply chain disruptions related to global tensions, it's a complex operating environment. There's also technology roadmap risk. They have to keep hitting their innovation milestones with things like high-NA. If they stumble, if the tech doesn't perform as expected or is delayed, it gives competitors a tiny window and disrupts customer plans.
And finding the right people.
That too. Competition for resources. Finding enough highly specialized engineers globally in optics, plasma physics, precision mechanics. It's a niche field, and talent is scarce. Attracting and retaining those people is a constant challenge.
So comparing these execution risks, ASMLs seem inherently higher just because of the complexity, right? More moving parts, more things that could go wrong compared to Nikon making DUV.
Absolutely. The complexity level is just orders of magnitude higher for ASML. Their execution risks, supply chain, technology ramp, customer timing are definitely greater than what Nikon or Canon face with their more mature, less complex DUV products.
But maybe more manageable than someone trying to start from scratch.
Exactly. Compared to SME, for instance, ASML's risks, while significant, are probably more manageable. SME faces fundamental technological hurdles, ecosystem limitations, and geopolitical constraints that are arguably much harder to overcome. ASML, despite the challenges, has a proven track record. They brought EUV from theory to high-volume manufacturing, which was a monumental feat. That shows they have serious operational chops.
Right. They've navigated complexity before. Okay, let's pivot to the stock performance. Because it's been, well, a bit confusing lately. ASML stock has lagged the broader semiconductor sector quite a bit, despite everything we've said about their dominance. What's going on there?
Yeah, it's been a key point of discussion. Over the last year or so, roughly to July 2025, ASML's ADRs, their U.S. listed shares, were down maybe 28%. Meanwhile, The main semiconductor index, the PHLX and ETS like SOXX, they were up significantly, 35%, really fueled by the whole AI hardware boom.
So huge divergence.
Massive. Now, other equipment makers also lagged, but ASML was a particularly noticeable underperformer. The Compasscope report we looked at kind of breaks it down. They attribute about 60% of this lag to broader cyclical factors and about 40% to things specific to ASML.
Okay, let's unpack that. 60% cyclical.
Right. So the big cyclical factor is what they call a booking drought. ASML's new orders in Q1 and Q2 2025, while recovering slightly in Q2, were way down from the peaks we saw earlier.
Yeah.
Bookings today translate to revenue way out in 2026, so the market sees these lower bookings and starts pricing in a flat, maybe even down year for ASML in 2026. It's a classic late cycle signal for equipment companies.
Investors looking ahead and getting nervous about 26.
Exactly. Plus, there's been a huge sector rotation. Money has flooded into the perceived direct AI winners, NVIDIA, AMD, Broadcom. The equipment guys whose earnings growth might look flat for 2025 or 2026 compared to the AI boom have kind of been left behind or derated. And then you have general macro worries like talk of potential U.S. tariffs on EU imports, adding another layer of uncertainty.
Okay, so that's the cyclical 60%. What about the 40% that's ASML specific?
A few things there. One is the ongoing export control and China risk. The bans on selling EUV and advanced DUV to China mean ASML gets a valuation discount, basically. Even though China's still a big customer for permitted DUV tools, maybe 20% of sales in 2025, that risk overhang weighs on the stock.
The China factor.
Definitely. Then there are some customer mix and node timing issues. Intel has had some delays in its roadmap. Samsung has reportedly pulled back a bit on its immediate EUV plans. That leaves TSMC carrying a lot of the initial load for high-NA EUV adoption, which just makes near-term visibility a bit cloudier.
So less certainty from two of the big three.
The very near term, yeah. And finally, there's the fact that high-NA EUV actually dilutes gross margins initially, maybe by 200, 300 basis points.
Wait, the newest, most expensive tech hurts margins. Why?
Because the supply chain for all the unique high-NA components isn't fully scaled up yet. Costs are higher on these first few systems. As volume ramps up, efficiency improves, and costs come down, margins will recover and eventually be very strong. But the initial rollout phase is expensive, and the uptake has been cautious so far.
Okay, that makes sense. So putting that context together, let's look at the very latest info, the Q2 earnings call from mid-July 2025. What were the key numbers and messages from management?
Sure. So Q2 itself was actually pretty solid financially. Net sales came in at 7.7 billion euros, right at the high end of their guidance. That was helped by recognizing revenue for one high-NA system earlier than expected and some extra upgrade business.
So top line was good?
Yep. Net system sales were 5.6 billion, split between EUV at 2.7 billion and non-EUV, mostly DUV, at 2.9 billion. Logic chips represented about 69% of system sales, memory 31%. And that installed base management revenue was strong too, 2.1 billion, also above guidance.
And margins, despite the high-NA dilution.
Gross margin was 53.7%, also better than guided. They mentioned the upgrade business helped, plus some one-off cost benefits. But yeah, they acknowledged the high-NA system did have a dilutive effect. Net income was 2.3 billion euros for an EPS of 5.90 euros. So decent bottom line too.
Okay, so the backward-looking numbers for Q2 were pretty good. What about the forward-looking indicators like bookings?
That's where the caution comes in. Q2 net system bookings were 5.5 billion euros. Better than Q1's low point, but still significantly down from the levels seen a year or two ago. EUV bookings were 2.3 billion, non-EUV 3.2 billion. Logic dominated the bookings at 84%.
So still not a roaring recovery in orders.
Not yet. The total backlog ended Q2 around 33 billion euros. But there was an interesting adjustment. They took out 1.4 billion euros related to customers responding to the 2024 export restrictions, mainly hitting DUV.
So customers canceling or adjusting orders due to the China restrictions.
Seems like it. It shows those geopolitical factors are having a real tangible impact on the order book.
Okay, so solid Q2 results, but cautious bookings reflecting the current environment. What did management say about the outlook for the rest of 2025 and into 2026? Where do they see things heading?
They really hammered home that AI is the key driver, both for logic chips, the processors, and memory chips, like the HBM needed for AI accelerators. They expect logic system revenue to increase overall in 2025 and memory to stay strong because chip makers are transitioning to new nodes for things like HBM and DDR5 memory, often requiring more EUV.
So AI is pulling demand through.
That's the narrative.
Yeah.
They mentioned China's expected to be over 25% of total revenue this year, which is high, largely due to fulfilling older DUV orders before restrictions tighten further. But they expect that proportion to moderate back towards China's share of the actual backlog over time.
What about EUV specifically for 2025?
They see customers adding EUV capacity, especially for AI. DRAM makers are using more EUV layers per chip. They expect about 30% more EUV capacity to be installed in 2025 versus 2024. Interestingly, because their newer NXE.3800E machine is more productive.
There's more work per hour.
Right. They can deliver that 30% capacity increase with roughly the same number of machine shipments as in 2024. But because these newer machines have higher prices and better margins for ASML, they expect overall EUV revenue to grow about 30% in 2025.
Ah, okay. Same number of boxes, but higher value boxes.
Exactly. DUV and metrology inspection revenues are expected to be roughly flat compared to 2024. But installed base management, the service business, they project to grow more than 20% this year. So adding it all up, for the full year 2025, they're now guiding for total revenue growth of around 15%, with a gross margin around 52%. But they did note demand is skewed towards the second half of the year.
Okay, 15% growth in 2025. That brings us to the elephant in the room. 2026, what was the message there? The market seems worried about a slowdown.
Yet management addressed this directly. They talked about the continued strong demand signals related to AI, both logic and memory, and the positive long-term trend of more EUV layers being used. But they also explicitly highlighted increasing uncertainties, macroeconomic worries, geopolitical tensions, and some specific customer challenges affecting the timing of their CapEx plans.
So hedging their bets a bit.
Very much so. The key quote was that due to these uncertainties, they cannot confirm growth at this stage for 2026. They added they are still paying for growth, meaning they're investing as if growth will happen, but they can't commit to it publicly yet.
Sounds like customers are maybe delaying decisions rather than canceling outright.
That seemed to be the implication. More of a delay of decision than a fundamental change of decision for now. But it clearly introduces caution into the 2026 outlook.
Okay. And what about the guidance for the immediate next quarter, Q3 2025?
For Q3, they expect net sales between 7.4 and 7.9 billion euros. Installed base management around 2 billion, gross margin between 50% and 52%. They specifically guided for margins to be lower in the second half compared to the first half.
Why lower margins in H2?
Primarily because they expect to recognize revenue for more of those initially dilutive high-NA systems. Also, they expect lower revenue from high-margin upgrades compared to the first half, and some of those one-off cost benefits they saw in H1 won't repeat.
Got it. High-NA ramp-up hits the margin line initially. What about the tech progress on high-NA? Any updates there?
Yeah, good progress reported. They shipped and started installing the first EXE.5200 system. That's the model intended for actual high-volume manufacturing. It's designed to run at 175 wafers per hour.
175 wafers per hour. How does that compare?
It's a big jump. About a 60% productivity improvement over the earlier EXE.5000 pilot systems. The whole point of high-NA, they reiterated, is to enable customer roadmaps for those future nodes and actually lower their cost of making advanced chips by moving from complex multi-patterning steps with current EUV to simpler single-exposure high-NA EUV.
Making the manufacturing simpler and cheaper, ultimately.
That's the goal. And despite the near-term caution, they held firm on their long-term 2030 targets that EUR 44 to 60 billion revenue range with 56% to 60% gross margins. They believe the end market dynamics fundamentally require more and more advanced lithography. Oh, and one final point from the call management did say customers seem more worried about potential tariffs now compared to 3 months ago, and that's definitely contributing to some CapEx caution.
The tariff talk is having a real effect on planning. Okay, this has been incredibly comprehensive, a real deep dive. So for our listeners trying to make sense of all this, what are the absolute key things they should watch going forward, if you had to rank them?
All right, boiling it down. Number one, absolutely critical. Advanced EUV and high-NA EUV adoption. Watch the pace at which TSMC, Samsung, and Intel actually deploy these systems. That drives the high-margin revenue.
The uptake of the latest tech.
Exactly. Second, keep a close eye on geopolitical and trade tensions. The U.S.-China situation, export controls, potential tariffs, these can directly impact ASML's market access and supply chain.
The political landscape.
Hugely important. Third, broader semiconductor industry demand and customer CapEx trends. Is the AI boom sustainable? Will chip makers keep spending aggressively on new fabs, or will we see a cyclical downturn or delays?
The health of the overall chip market.
Yeah. Fourth, ASML's own technology roadmap execution. Can they deliver high NA on time and meet performance specs? Any stumbles there are significant. And fifth, closely related supply chain resilience. Any issues, especially with Zeiss, could cause production problems.
For tech adoption, geopolitics, market cycle, execution, and suppliers. Those are the big ones.
I'd say those are the top 5 that will really shape ASML's performance. After that, you've got things like the growth of their installed base management, any surprising moves from competitors, though unlikely, broader macroeconomics, and their own R&D effectiveness. But those first few are really paramount right now. Tracking these is key to understanding ASML's trajectory.
What an incredible journey into the real engine room of modern technology. We've really peeled back the layers on ASML, the business, that unique competitive strength, but also the complex mix of opportunities and challenges they face.
It really is a fascinating case study, isn't it? And maybe the question for you, the listener, to think about is, how much of ASML's future relies on pushing that absolute cutting edge of physics and engineering versus how much is tied to the, well, unpredictable winds of global politics and economic cycles? It's a really delicate balance they have to strike.
A crucial balance indeed. Well, that's all the time we have for this deep dive. We hope you feel a bit more informed, maybe a lot more curious about these often invisible forces that are truly shaping our tech-driven world. Until next time. This content is produced by Compasscope.com. For more than 1,100 public listed companies, find detailed research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.